Hi, this is Patrick Adams with This Week's Market in a Minute. And what's new this week is the fundamentals have been negative for quite a while. Now the technicals have turned negative. So we'd like to kind of walk through what's going on in the banking area and how to deal with this negative market. So if you look at the S&P 500, the blue line here is the S&P 500, and the purple line is the 200-day moving average. So that's the important moving average for most technical analysts. If the market breaks the 200-day moving average, you basically want to get out of the way of it. Now, what we do is we get out of the way a little bit earlier. So, as I mentioned a couple weeks ago, the market felt like a 1987 event was going to occur. I just felt it in my bones. I've been managing money since 1985. I remember 1987 like it was yesterday. It was my first bear market, and it all came in one day. So what's happening currently? The market couldn't hold this support level, this resistance level at 4170. It just couldn't stay above it. So it began to decline, breaking through the 20-day moving average here in red, which was the first flash signal to get defensive for us. So I raised some money in our portfolios at this point, did it again here at the 50-day, and by the time we're breaking the 200-day, we're very defensive and don't have a whole lot to do to even be more defensive to make sure our portfolios don't decline. Now at 3,800, this is a good support level for the S&P 500. It could hold this level, as long as the Federal Reserve doesn't get aggressive next week when they talk about monetary policy, and as long as the inflation numbers are okay. So if the Fed continues to raise rates in a negative, basically setup, it's going to have more impact on the economy and the stock market. So looking at what happened last week, and boy did it occur quickly. So $600 billion of losses is on the balance sheet at banks in what they own in their treasury bonds. So they have a portion of their assets, a large portion, that's held to maturity. So that means they hold it for the duration, and they get their money back at the end of that period of time. Now, if they have to go in and liquidate some of these holdings, then they're realizing losses and they become insolvent like Silicon Valley Bank did. Now, the Federal Reserve, their intent is to take the bubble out of the bond market. And the Federal Reserve busted the bond market, essentially busted the bubble in the bond market. The long bond, the 10-year bond, has gone up 300 to 350 basis points. Again, similar to what happened in 1987. So it's gone up quite a bit. The banking sector is now 21% below this major decline last week, 21% below the 200-day moving average. Certainly the market's concerned about this. Now, we view this as a potential capitulation sell-off to come in and start buying some of the better banks. The banking sector is off 38% from its high. That certainly is a bear market. So it's kind of interesting to us, but we're not convinced quite yet that the sector has bottomed out, and we're not going to see more issues occur as we go forward. Looking at the Fed tightening cycles, this explains everything, really. So this is the last three tightening cycles that have occurred. You can see this one basically starts at roughly 0 and goes up 475 basis points in a year. That is crazy fast. Of course the Fed broke something. It's not surprising. If you go back and look at the 1999-2000 period, the Federal Reserve increased rates roughly 1.5% or so, and followed by a recession. What was really occurring in this period was a huge valuation issue in technology stocks, coupled with higher interest rates. So the result was a catastrophe for the stock market. I'm not think we're having that sort of event occur. But then you look at 2004 into 2007, again, major increase in interest rates caused the financial crisis, in my opinion, along with some sloppy lending, a lot of sloppy lending in the housing area. So we are looking at potentially something similar that could occur, as long as the Federal Reserve is so intent on killing inflation off without regard to the economy or the stock market. So what to do in this period of time is just relax, get defensive, let it play out. There'll be a huge buying opportunity later this year or into 2024. And at that point, you can make significant returns. So as you know, the markets are very robust coming out of a recession or a major decline in the overall markets. You'll earn much higher than the traditional 10% that the market does over the long term. And it's not worth taking the risk at this point. So please hit like and subscribe. And then if you want a hard copy of Market in a Minute, go to my website, Patrick Adams CFA, and we'll email that out to you on a weekly basis. Take care.